This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, you had a really interesting title this week on your report. There ain't no such thing as a free lunch. And, you and I have been through a lot of free lunches since the 90s.
Yeah, we have. We have. Yeah, look, one of my favorite little phrases there, I always pronounce it TANSTOFL. I'm not sure if that's the way you should pronounce that acronym, but that's what it means. There ain't no such thing as a free lunch. It's really old, but it was popularized by Heinlein's book, The Moon is a Harsh Mistress from 1966, but it goes back quite a ways. But, it's an economic term, and it's true. There's no such thing as a free lunch. You can't use something twice, and oftentimes, you remember you were in the brokerage business too. You remember those mutual fund sales guys would come and feed you a free lunch. Yeah, but you had to listen to the pitch too, man. So there's no such thing as a free lunch.
Well, you had the one in the late 90s, the .coms. And then about 10 years later, we had real estate. And then we got into the 2010s. And that was when you had lots of companies that were way overvalued and they didn't have any earnings.
Yeah, look, all of these things are bubbles. I mean, look, I really don't like the term bubble because it implies that there's, some irrational thing going on. And I think when we look back on these things, they are certainly irrational. But at the time, they often don't seem irrational. I'll give you an example. Mark Cuban, who is considered to be this brilliant guy and billionaire, owns the Dallas Mavericks and all that, and he's on TV all the time with Shark Tank on CNBC. Well, he made his money from a company called broadcast.com. Broadcast.com started in the mid 90s, I think. And I don't think Cuban was even a founder. I think he was brought in later. Although I do think he ended up being the largest shareholder. Well, they ended up selling that company to Yahoo in 2000, just a few months before. I think it was 2000. It might have been late 99, but whatever. It was right near the top. $5.4 billion, I think they sold it for. And Yahoo wanted to give him stock. And he said, no, I'll take cash. Smart guy. And so ultimately they sold the company, and Yahoo, it operated for a while there. And then I think ultimately it was shut down. The bottom line is it was just a waste of money for Yahoo, which was not the first thing or the last thing that they wasted money on, but that's a whole nother story. But the point is that the valuation on broadcast.com at the time, we look back on it now, it's like, well, that was stupid. Why did Yahoo pay so much? But I think we forget what broadcast.com was. It was a streaming company. So was it irrational or was it just early? Look, in the late 1990s, there just weren't enough people out there with broadband access to make streaming work. Was Mark Cuban just way ahead of his time? Maybe. So was broadcast.com irrational? Well, maybe not. Anyway, the point is that these bubbles, if you want to call them that, since that's what the popular nomenclature is, they happen for a lot of reasons. A lot of them are driven by new technologies, as broadcast.com was. And we've seen this throughout history. But, it's oftentimes we blame these things on monetary policy, but it's really kind of odd. If you think about the late 90s, we had a very strong dollar period, and we had a bubble in tech stocks and .com. And then we had a very weak dollar through the 2000s, and we got a bubble in real estate. We got bubbles in both cases because we had an extreme move in the currency. A very strong currency attracts a lot of capital flows, and it's kind of this self-perpetuating thing where the dollar is strong, so it attracts investment, which makes the dollar get stronger, which attracts more investment, and so forth and so on, until you draw in so much capital in the United States that you're putting money in pets.com. So there's that way that you can get a bubble, and there's the opposite, which has happened in the 2000s with real estate, where the dollar is going down all the time. People buy real estate and other hard assets to protect their purchasing power. So we had a similar thing in this last decade where the dollar was fairly strong, and we did get a lot of capital inflows to the United States. I mean, we talked for years there about that the U.S. was the cleanest dirty shirt in the laundry, or whatever you want to call it. But the bottom line is that this excess capital has to go somewhere. And usually if you get way too much capital versus reasonable investment opportunities, then it goes into things that are not reasonable investment opportunities. And so you end up with crypto. And I wrote about this week because I think a lot of people in recent years kind of seem to believe that this crypto space was a place where they could go get rich and it was really easy and they were paying these high rates of return and it was really safe. And last week we found out, well, indeed, that's not true. There is no such thing as a free lunch. If your anchor account, if your Luna Terra crypto coin and you deposit in an anchor account and they're paying you 20%, I got to tell you, it's stupid. You can't get 20% in this environment. And actually, I always tell people, look, think about it from the other direction. If somebody's offering you a high rate of return to lend money to them, think about this. Right now, someone with a reasonable credit score can go out and get a mortgage for 5.25%, 5.5% for a 30-year mortgage. Now, look, admittedly, that's twice what it was, a year and a half, 2 years ago, but it's still a fairly low rate. So if somebody's saying to you, I will pay you 20% per year to borrow your money, how creditworthy do you think they are? I'm going to say not very. So this thing blew up last week, and I just think it's symptomatic of what's going on. And now we have a very strong dollar. Gold stopped going up, so the dollar is strong, and we're starting to see some of the impact of that. This is a liquidity coming out of the system, and it comes out of the most speculative places first. And so it's come out of crypto, and it'll come out of growth stocks, and it comes out of these unicorn stocks that went public via SPACs, and all these electric car companies that have never made a freaking car. There's going to be a lot of things like that. And so, look, it is what it is. I've been through this a bunch of times. And I always tell people, look, there may be something valuable in the crypto space, but I will tell you something, figuring out what that is right now is impossible. Wait for the bust, see what survives, and then you might find something worthwhile. But until then, it's all a crapshoot, and I'm not interested in crapshoots.
Well, the dollar index did hit a 20-year high. So what kind of stress is that putting on the global economy?
Well, look, it does put some stress on other countries that have dollar denominated debts. It seems to be so far fairly orderly. We have seen India has had to intervene in the currency markets trying to support the rupee, which won't work. Those things never work, but they'll try it for a while. We've seen other countries have to raise interest rates trying to protect their currency, and that's typical. But this has been fairly orderly and fairly slow. I would think that in general, companies would have the opportunity to hedge their risk, but we don't know that. And there's always somebody that's too dumb to hedge their risk or something, and you end up with some kind of problem. Look, we know that Korea and some other countries are having some issues with a strong dollar, but right now it seems like it's something that's being managed. We'll see how far this goes. I actually think that the yen maybe has hit a bottom here, at least short term. The euro is trying to struggling to try to find a bottom. I'm not sure it's ready yet, and maybe it's going to par. I don't know. But like I said, look, a strong dollar in and of itself is not a bad thing. It is the rapidity of it, how fast it happens, and I guess why it happens. In this case, I think there's a couple of things going on. I don't think it's necessarily that we're just in a better position than everybody else in the world economically, although certainly you can make that argument. I think that a lot of this has to do with the Ukraine war, where there is stresses throughout the global system because of what's going on in Ukraine from the resource side, food, energy, and so forth, that also has a feedback loop into the dollar. So look, like I said, I think it's reasonable right now, but we got to watch it. I mean, look, if the dollar really takes off and goes a lot higher, it can cause issues. And we've seen that throughout history. So we're keeping an eye on that.
Credit spreads have widened. Any concern about that?
Well, yes, yeah, some. I mean, look, we get 477 last week, I think, on the credit spreads on the ones we watch, the high yield credit spreads. It's up about 150 basis points from the low. We would generally get more concerned if we look for kind of a 200 basis point move to start really getting concerned. We haven't seen that yet. It is getting close, though, and certainly it's something that we're keeping an eye on. As I said, though, too, listen, if credit spreads got wider here, as long as they don't go to the moon, as long as we don't see, 10% spreads or something like that. I mean, we're at 477 now. If you go, up 10, 15%, then that's a problem. But just wider spreads in and of themselves, I'm not sure it's a bad thing. Anybody with a pulse could borrow, in a corporate world anyway, could borrow money over the last few years. Maybe that's not a good thing. Maybe we should have a little bit tighter credit or a more rational rationing of credit, as I said in the piece. I think that there's a lot of zombies out there, zombie companies out there being propped up by cheap credit. Maybe cheap credit is not the answer.
Market finished down last week. Lots of things going on, kind of minor things, but two things I want to ask you about. Number one, real estate. What did you see?
Yeah, look, REITs have been hit pretty hard here as rates went up. That last little spike up in rates really hurt the REIT market, the REIT stocks. I think they're probably finding a bottom here. They were up Friday. They're up again today. Real rates seem like they have peaked. We did extend duration a little bit last week. We're kind of sitting on a barbell right now where we've got some short-term stuff that's a small piece. The vast majority sitting in the middle and intermediate, and we got a small piece on the long end. What's kind of known as a barbell, but it's a light barbell. We don't have a big piece on either end. The bulk of our fixed income is in the middle. So REITs obviously are interest rate sensitive. They're also sensitive to the dollar. They don't tend to perform that well when the dollar is going up either. So you get kind of a double whammy here, but I suspect both of those things are going to ease a little bit and REITs will be fine.
And what about commodities?
Yeah, commodities were down last week. Look, commodities is the only thing that's really a big asset class that's up over the last year. I think it's probably due for a rest. We've probably done what we're going to do there, at least short term. I think you're going to see the economy slow a little bit here. The dollar has been strong, which is also generally negative for commodities. We'll see what happens, but I don't think the commodity bull market's done. These things tend to last a long time. And we had one previously that ran from the late 90s into 2008. You had two big corrections along the way of 30% plus, but the trend was obviously up for that period of that rough decade, basically. And we've only been a couple of years into this. So to get a big pullback here, remember, commodities are going to be more volatile than stocks. So when we talk about a correction in commodities, you might be talking a 25, 30% move versus 20% for stocks. I think you could get a correction here. I don't know if it's that big, but you could get a correction here or sometime soon. And then I think you're probably going to see commodities continue to move higher. I think in the longer run here, kind of big picture, I think we're moving from a world that will probably involve somewhat higher interest rates and somewhat higher inflation rates. But that's a very long-term view. It's not something that necessarily happens in the short term.
You know, you wrapped up the written article with, you could almost say it was advice from mom, but you said quality is the most important factor right now.
Yeah, look, I mean, I look at this stuff and it's like, I look at a lot of the things that have been hit so hard, and I don't see how people could possibly be surprised. I mean, we're talking about companies in a lot of cases that have never made a nickel, and some of them have. I don't think they have any hope of ever earning a nickel. Netflix to me was a levitation act that just didn't make any sense for a long time, and I know for a fact, they spent a lot of money, borrowed a lot of money, spent a lot of money doing content. And I don't know if you've been on Netflix, but quite frankly, I can't find anything on there to watch. So why anybody surprised that they spent all that money on content that really wasn't that good and that they end up, the stock is in the toilet? Why are you surprised? Same thing with Peloton. I'm sorry, but, can you point me to the big, exercise equipment mogul in the planet? Because I don't know. I don't think he exists. It's a very competitive business. And all they did was strap a freaking iPad on a stationary bike. It's not that complicated. They've never made any money. Maybe they turned a small profit somewhere, but it's just crazy to think that where they were during COVID, during lockdown, that they were going to stay there and continue to be successful. I mean, did anybody really think that Peloton finally had the offering that was going to solve the obesity problem in America? Yeah, I don't think so. And those are examples of actual real companies making real products, at least. There's plenty of other things out there that just this crypto space, there's no there. There's no utility to this stuff. It doesn't mean anything. I don't think anybody should be surprised when they turn, because it's all about mass psychology. And the psychology has turned bearish on these things, and it's probably going to get worse. But if you own high quality things, you own real companies that make real things that people want and need, and you pay a reasonable price for it, and especially if it pays a dividend, I think you're going to be fine. If you own a bunch of weird things that you have no idea if they're ever going to make any money, or you can't even explain to me in a couple of sentences what the hell they do, then I'm sorry, but you are in trouble. And it's probably going to stay that way for a while.